Welcome back. This is Retirement News Online. So retirement should be a time of peace of mind, not constant worry, obviously. But the truth is, risks don't disappear once you stop working. They just kind of change. From market swings to inflation to living longer than expected, risk management is one of the most important parts of retirement planning. In this interview, we'll talk about how to identify those risks and create strategies to keep them under control. And joining me is my guest, Dariusz Godlewski. He is the principal at Kaizen Wealth Advisors in Chicago, Illinois. Kaizen is a Japanese business kind of strategy. Talk about what that means.
Kaizen, it's a Japanese philosophy, mostly used in corporate world. I think it was first introduced in Toyota, and it basically means continuous improvement and attention to details.
Those are good things.
Yeah.
So let's go back to risk. How do you define risk in retirement planning? Because I think a lot of people just think about market risk, but it's more than that.
When most people think of risk, they picture the stock market going up and down. But in retirement, risk is much broader than that. It's not just about the market volatility, it's also about living longer than expected and the rising cost of healthcare, inflation, and even future tax changes. And all of these factors can chip away at someone's nest egg if they aren't prepared. And the way I define risk is simple. It's anything that could threaten your ability to live comfortably and confidently throughout retirement. And my role as an advisor is to help identify those risks early and then put strategies in place to reduce the impact. The goal isn't to eliminate risk altogether, that's impossible, but to manage it in a way that gives clients peace of mind.
So when you talk to clients, what do you think the common mistakes people typically make when it comes to risk and when it relates to retirement and financial planning?
One of the biggest mistakes is going to extremes, and some people invest way too aggressively, chasing returns without realizing how much they could lose in a downturn. Others go to opposite way. They pull out of the market completely and keep everything in cash or CDs. And both those approaches create problems. The key is balance. You don't want to avoid risk entirely because then inflation and taxes eat away at your savings. But you also don't want to take on too much risk that the one bad market year could derail your plan. So my job is to help clients find that middle ground where their investments align with their stage of life and their income needs and their comfort level.
And let's talk about, again, protecting someone's retirement savings. This is savings that they've worked so hard to build, and they're planning to, spend retirement with that without a paycheck. But as we talked about, we're talking about risk. Now people are living longer, which is a risk in and of itself. They have to pay for this retirement for as many as 20, 30, maybe even 40 years. How do you keep them from losing the retirement savings, protecting it, but still, I guess, keeping your foot on the gas pedal for growth?
So one of the best ways to protect retirement savings is through diversification and spreading money across different types of investments and strategies, so you are not dependent on just one outcome. And that way, if one area struggles, another can help balance it out. So for many of my clients, that also means looking at products that provide guarantees, like annuities or certain insurance-based strategies. And these tools can help protect a portion of your principal or ensure you'll have enough income for life, no matter what the markets do. So it's about creating a safety net. And the goal isn't to gamble with your life savings, it's to make sure that your retirement paycheck is reliable and your core assets are protected.
And so let's talk about inflation, which is really the concept of purchasing power. How do you deal with inflation risk, keep up with inflation? How do you manage assets around that?
No, inflation is like, it's a silent risk. It creeps in year after year, and before you know it, the money that once covered your lifestyle just isn't enough. And to fight that, you need growth. Even in retirement, part of your portfolio should be positioned for long-term growth, whether that's stocks, real estate, or inflation-protected strategies or bonds. At the same time, it's about balance. And you want safety for your immediate needs, but also growth for your future needs. Think of it as having two buckets. One that's stable and predictable, and another that's designed to outpace inflation over time. And that way your income keeps up with rising prices and you maintain your standard of living.
And then finally, for somebody who is worried about risk, I mean, we see market volatility, we see policy risk in Washington, you know, things changing all the time there. What's your best advice for somebody who's concerned about risk overall?
Well, my biggest piece of advice is don't postpone your decisions. Risk doesn't go away just because you don't think about it. The earlier you start planning and actually talking about those risks, whether it's market swings, inflation, taxes, or even outliving your money, the more options you'll have to manage them. And the more options mean more control. And when you build a plan, you create a roadmap that helps you feel confident no matter what happens. You don't have to react to every market headline or every new tax law, because your plan already accounts for those possibilities. It's a proactive approach. And at the end of the day, that plan gives you the peace of mind. And really, the peace of mind is the best rate of return anyone can have in retirement.
Thank you, Dariusz. My guest has been Dariusz Godlewski with Kaizen Wealth Advisors in Chicago, Illinois. This has been Retirement News Online. Thanks for watching.